I wonder, have you felt the squeeze lately? The relentless pressure on your household budget, the rising cost of nearly everything you buy. For millions across the United Kingdom, this isn't just a feeling, it's a harsh reality, a daily struggle to make ends meet. What I want to tell you today is that much of this struggle, particularly for homeowners, traces back to a series of critical decisions made by a single, powerful institution, the Bank of England. It's a story that feels almost like a secret plan, not in the sense of a conspiracy, but in the profound, often unforeseen impact of seemingly abstract economic policy on the very foundations of our lives. I've seen firsthand how these policies translate into real anguish for families, how they dictate whether you can afford your mortgage, put food on the table, or even keep your home. We are on a mission to reach 10,000 subscribers to build a community that is aware of these financial shifts. If that resonates with you, hit subscribe. Here's what I think you need to understand. The Bank of England, from its imposing headquarters on Threadneedle Street in London, holds immense power. Its Monetary Policy Committee makes choices that can either buoy or sink the financial hopes of an entire nation. And as we stand here at the very beginning of 2026, I believe we are about to witness the true culmination of those choices. You might be surprised to learn just how deeply intertwined your mortgage payments, your weekly grocery bill, and your overall financial stability are with the movements of a single interest rate. This isn't just about numbers, it's about homes, families, and the bedrock of the British economy. I want to lay bare the truth of what has happened, what is happening, and what is expected to come. Let me take you back a few years to a time that in hindsight feels like a calm before a storm. In 2020 and 2021, during the depths of the pandemic, millions of homeowners across the United Kingdom locked into what seemed like unbelievably low fixed-rate mortgages. It was a period of unprecedented economic stimulus designed to keep the economy afloat. Those rates, I remember them well, were a lifeline for many, allowing people to buy homes or refinance at costs that now seem almost mythical. They offered a sense of security, a predictable monthly payment in an unpredictable world. But, as I've observed time and again, every period of artificial calm eventually gives way to the natural ebb and flow of the market. The Bank of England, faced with soaring inflation in the wake of the pandemic and global events, began to act decisively. From December 2021 to July 2023, the base interest rate was aggressively hiked, reaching a peak of 5.25%. This was a necessary, albeit painful, medicine to combat rising prices. I recall the headlines, the growing anxiety among households as the cost of living began its relentless ascent. Energy bills soared, food prices jumped, and for those with variable rate mortgages, the impact was immediate. It was a stark reminder that economic stability is a delicate balance, and sometimes the cure can feel as debilitating as the disease. But the real shockwave, the one that I believe is about to hit, comes from the confluence of those pandemic-era fixed rates expiring and the current higher interest rate environment. This isn't just a minor adjustment, it's a fundamental shift that will redefine financial stability for millions of families across the country. The stakes, as I see them, couldn't be higher. We are talking about the potential for widespread financial distress, about homeowners being forced to make impossible choices. This isn't hyperbole, it's a projection based on the most rigorous economic analyses, and I want to walk you through exactly what that means for you and your neighbours. What I find fascinating and frankly quite alarming is how a decision made by a small committee can have such a monumental personal impact. It's a testament to the intricate web of finance that underpins our society. So, let's peel back the layers and confront the reality of what the Bank of England's actions have set in motion. This isn't just a story about numbers on a spreadsheet, it's about the young couple who stretched to buy their first home, now wondering if they can afford to keep it. It's about the retired couple on a fixed income whose mortgage payment is about to jump dramatically. It is, in essence, about the very fabric of our communities. The Bank of England's initial response to inflation was robust. By August 2023, the base rate stood at 5.25%, a level not seen in many years. This period, from late 2021, marked a significant departure from the ultra-low rates that had characterised the preceding decade. It was a necessary tightening aimed at cooling an overheating economy. However, the pressure on households continued to mount. I observed a growing chorus of voices from financial experts to ordinary citizens calling for relief. The cost of living crisis wasn't just a phrase, it was a daily grind of difficult choices in supermarkets and at petrol pumps. Wages for many simply weren't keeping pace with the soaring prices of essentials. Recognising this immense strain, the Bank of England began to pivot. By October 2025, after a series of cuts initiated in July 2024, the base rate had dropped to 4%. This provided some initial relief, a glimmer of hope for many struggling families. I saw a slight easing of mortgage rates, a small but welcome reprieve. But even with these cuts, the situation remained precarious. On December the 18th, 2025, the Bank of England cut the base rate to 3.75%. This decision, while not a cut, was met with mixed reactions. Experts I spoke with anticipated further easing, with some even predicting a potential cut as early as December 2025. The broader market sentiment, however, points to a more significant shift upcoming in 2026. A Reuters poll from October 2025 revealed that 50% of economists expected a base rate cut by March 2026 and 60% by the second quarter of 2026. The consensus was a potential drop to 3.5% by June 2026. This is where the plot thickens, where the secret plan truly begins to unfold for millions of homeowners. The critical factor, the ticking time bomb if you will, is the sheer volume of fixed-rate mortgages that are set to expire in 2026. We are talking about approximately 1.8 million UK mortgages that were locked in at those pandemic-era lows. These are the mortgages taken out or refinanced in 2020 and 2021, when rates were incredibly cheap, some even below 2%. Those homeowners enjoyed a period of unprecedented affordability, and now they are facing a rude awakening. UK finance data, a body I often consult, projects a 10% surge in remortgaging activity specifically due to these expirations. Let me paint a picture of the impact. The Bank of England's own projections are stark. They indicate that nearly 1 million households will face monthly mortgage payment increases of £500 or more by late 2026. That's over £6,000 annually, a sum that can completely derail a family's budget, and it doesn't stop there. Another 2 million households are expected to see rises of between £200 and £499 per month. Imagine budgeting for a fixed amount, only to suddenly find an extra £200, £300 or even £500 disappearing from your account each month. It's a seismic shift for household finances. What I've observed is that these figures aren't just statistics, they represent families cutting back on essentials, delaying crucial repairs or even considering selling their homes. For a typical £250,000 repayment mortgage over 20 years, a drop from 4% to 3% interest would reduce monthly payments from £1,514 to £1,386. This saves £155 monthly. While a welcome relief, it's still far from the rates many were enjoying just a few years ago. That £155, I've heard from many, is equivalent to an extra weekly grocery shop for a family, a tangible difference in their quality of life. For those with tracker mortgages, the immediate impact of rate cuts is more direct. Tracker mortgage holders save about £25 monthly per £100,000 borrowed for every quarter-point base rate cut. This offers a more immediate form of relief, but they also felt the pain more acutely during the initial rate hikes. Despite the recent cuts and the anticipation of more to come, inflation remains a nagging concern. As of late 2025, it was still above the Bank of England's 2% target. This explains their cautious approach, their reluctance to cut rates too aggressively, even amid widespread calls for faster action to alleviate the cost of living crisis. The challenge for the Bank of England is immense: how to bring inflation down to target without tipping the economy into a deep recession and without crushing homeowners with unsustainable mortgage costs. It's a tightrope walk that affects every single one of us, whether we own a home or not. I've also noticed how lenders are trying to adapt to this challenging environment. Nationwide, for instance, offers up to 6 times income for first-time buyers through its Helping Hand scheme. NatWest allows 5.5 times income for earners over £40,000, and Loughborough Building Society has similar offerings. This means a £45,000 earner could now borrow £270,000, up from £202,500. These increased loan-to-income ratios are designed to boost affordability and help people get onto the housing ladder or move up it. But I also wonder if they are simply pushing the problem further down the road for some. Are these measures truly helping, or are they encouraging people to take on more debt at a time when future interest rates remain uncertain? It's a question I've heard many financial experts like Rachel Springall from Money Facts ponder. She advises caution, especially for those remortgaging from those incredibly cheap pandemic rates. The landscape has fundamentally shifted. The warnings from the Bank of England itself have been consistent. Back in 2023, they cautioned that mortgage repayments could jump by £500 for 1 million households. That prediction, I believe, is now accelerating into the 2026 expirations, solidifying into a grim reality for many. It's crucial to understand that while average 2-year fixed mortgage rates fell below 5% in late 2025, reaching 4.83%, and 5-year fixes dropped to 4.91%, these figures are still significantly higher than the rates seen in 2020 and 2021. The new normal is simply more expensive. So what does this all mean for the upcoming year, 2026? What is the expected resolution to this complex economic drama? I think it's important to manage expectations because while there is relief on the horizon, the challenges will remain significant for many. Markets are currently expecting the base rate to stabilise at around 3.5% by mid-2026, with some projections even suggesting a further dip to 3.25% from a late 2025 level of 3.75%. This would be a welcome reduction from the peak, offering some much-needed breathing room. This expected easing of rates, combined with the efforts of lenders to offer more competitive deals, is predicted to inject some optimism into the mortgage markets in 2026. UK finance data points to this heightened optimism, but it comes with a strong caveat. The risks remain very real for those remortgaging from those ultra-cheap pandemic deals. The resolution then is not a sudden return to the easy money days. Instead, it's a gradual adjustment to a new, more expensive reality. For those 1.8 million homeowners whose mortgages are expiring, the decision will be stark: accept significantly higher payments or explore options like extending their mortgage term, switching lenders, or in some cases even downsizing. What I've concluded is that the Bank of England's secret plan isn't a malicious plot, but rather the unavoidable consequence of navigating a turbulent global economy. Their mandate is to control inflation, and the tools they use, primarily interest rates, have a direct and profound effect on every household. The shockwaves from those rate hikes are now reaching their crescendo. As we move through 2026, I anticipate a period of continued financial adjustment for millions, We will see families making tough choices, adapting to a world where housing costs command a larger portion of their income. It's a challenge, yes, but also a testament to the resilience of the British people. I believe that understanding these mechanisms, seeing the connection between the grand decisions made in Threadneedle Street and the daily struggles in your home, is empowering. It allows us to prepare, to advocate, and to demand accountability from the institutions that shape our financial futures. The story of the Bank of England's impact on homeowners is far from over. As those 1.8 million mortgages expire, the true cost of battling inflation will be borne by individual families. My hope is that by shedding light on this intricate web of economics and personal finance, we can navigate the upcoming challenges with greater awareness and resilience.